Hello, everyone. It's 11 o'clock. I'll wait a couple more minutes, or at least 60 seconds. Some very familiar names on the list. Lots of advisors, good to see. Naomi, Michael, Harris, Tony, Michael Harwood, Brett Young, Brett Young's bedroom. Okay, we'll get going. Just in terms of just covering off some housekeeping matters. Everyone has been muted. Please stay on mute through the course of the presentation. You will get the opportunity to ask a question. Please use the chat feature. I'm ably supported by my co-host up there in Noosa, Stacey Golly, and you can see her. Give us a wave, Stace. Great. Please, if you do have any questions, I will try and do my best to answer them at the end. Now, if there is a question that you really want answered, please copy and paste that person's question and repost it in the chat, just in terms of priorities, so Stacey can manage the Q&A at the end. Now, if I don't get to any questions, we'll do our best to cover them off post the presentation. So I'm going to get straight into it. So this is advice at 10,000 feet, basically. Lots of issues to cover. This was based on surveys across a number of, participants in the industry, consumers, advisors, many of which you participated in the survey that we've undertaken, heads of distribution, digital advice tools that have actually used by institutions. So the institutions that conducted those, or that use those in the business, and a bunch of other data points that we've used to collate this, as well as qualitative data, interviews and the like, to pull this research piece together. It was about 5 months worth of research, so I can't take all the credit here. Fortunately, I've got a good team around me that can pull this information together. Nice to see you on the chat there, Lee. So I'm going to go straight into it. So the one overarching word that I'd love to use as part of advice in 2020 is that of empathy. Now, whether you're a product manufacturer that's on this presentation or whether you're a fellow advisor, I think without doubt, it's important to understand the implications of the stresses of the last few years. Compliance burdens, obviously through the roof, going back to university, for many advisors, of which they are over, the average age of an advisor is over 50. So being forced back to university has been troublesome and a bit of a heartache for many. And obviously the pandemic itself. So the pandemic actually resulting in much longer working hours and impacts to their own clients. Now, I'm not going to actually quote this quote. This was an email I received, and it's an email that sort of is very much in concert with a lot of correspondence that has come through to my LinkedIn and also to my email over the last 12 months. And to be honest, it's fairly confrontational. It's fairly upsetting in terms of the impact to more than 20% of advisors who have left the market, much off their own accord, or not to their own accord. So I just think it would be very mindful as we go through this presentation to think of that word. And also, if we're going through the industry over the next 12 months and 24 months for those that are staying, or thinking about leaving, especially if you're a product manufacturer, I think that word empathy is something that you need to understand when you're sitting down in front of the advisors. On a far brighter note, let's talk about trust in financial advisors. And as we all know, advice is all about trust, and to make an impact, advisors rely on radical transparency. And in 2020, I'm happy to say that trust really turned a corner. You see, in 2018, excuse the middle finger there, but trust was down in the doldrums, back off the back of the Royal Commission. But in 2020, we saw a significant turnaround back to near its peak in the early 2000s or late 90s, when the last boom era sort of happened. Now, this is important because obvious client engagement, client acquisition, and all of that can only be achieved through trust. Now, with existing clients, we know that advisors are trusted, but it's also the impression across the industry, and this is the impression across the industry now that advice is back. I guess what I would call advice is back in vogue. We've seen through our platform already in the last sort of 12 months, especially a massive increase in leads to advisors. And there's actually a rebasing of those leads now. So that's carried right through to 2021. And this is through not only our platform, but the other platforms that we service. For those that don't know, we also do a find an advisor solution for Australian Super. And we are also the front end for the ASX. And they are also seeing an increase in advice. Now, the ASX are CHESS trading participants. So if you're an advisor sitting there and you're not a CHESS trading participant, don't worry. We are working through that with the ASX. But at the moment, it's mostly stockbrokers and the like. Despite this, the advisor market has been decreasing. For those that follow my weekly advisor movements over the last 12 months, and our musical chairs report, you'll notice that there has been a dwindling supply, which has led to a huge increase in prices, a 30% increase in prices across the last 2 years. So from an average medium fee now, advisors are charging is $3,240. Now that may seem low to some of you, depending on where you sit on the paradigm of fees. But that is, bear in mind, this is spread across all 20,000 advisors in the market, some with different propositions than others. I know many that I do speak to sort of north of that. But that is an indication of where this market is headed because of the supply constraints and because of the compliance burdens up front. And that will also obviously have implications for product manufacturers down the train. Now, bear with me as I go through this presentation. I'm going to be directing this both at advisors and the participants or the wealth participants within that network. So I know I have quite a few fund managers, life insurers, and the like also on this presentation. So I'll try and be one for all. So despite this demand increase, the actual size of the market did decrease in 2020. We saw a 2.5% absolute decline from 2018 highs in terms of those seeking advice, of the 2.1 million who do seek advice. So, and which is an actual 25% drop in relative terms to 2018. And the key reasons for that are basically two. Is the unaffordable nature of advice, as I mentioned before, the 30% increase in fees. And we are now starting to see advisors divorcing their clients. So this is a theme that ran through in 2020, advisors calling up their clients to basically cull them and becoming orphan clients across the industry, which is a concern. It's obviously a concern that we've raised with both government and the regulator. And I know, obviously, I think we all know that there is talk around scaled advice. We'll see what that actually means and what the legislation sort of transpires out of that. But it is obviously something that we all need to think about in terms of our business models going forward, or the advisors' business models going forward, but also the product manufacturers, is how do we get more people into advice? We know government can be particularly laggards in this space, especially with financial planners being somewhat of an easy target over the last 2 years on the back of the Royal Commission. And that's really unfortunate, to the detriment of Australians. One of the other data points that came out of our consumer survey, now this is a broad reaching survey across 3,500 consumers, and this is quite pleasing, is despite the fact that their advice is not as affordable as it once was, we are seeing the demand, particularly in the sub 45 category. So on average, about 35% of those below 45 are intending on seeing an advisor. Obviously, the barriers to advice is cost, but that it bodes well. And this is particularly pleasing to see in terms of the demand for those that stay in the industry and for those that can work through their business models. So, and it goes to my trust element earlier in terms of the massive increase in trust for financial planners through the course of the pandemic. And I know many of you there that I can see all the names spent many hours with their clients over the last 12 months, especially in the early years of 20 or the early months of 2020, making sure that they felt comfortable. And that also showed in terms of when we talked to clients of advisors, they felt far more at ease with their finances than those without an advisor. What I will say is technology will have a role to play for those that are unadvised. Now, in this survey as well, 1 to 2% of 1 to sort of 3%, I should say, of consumers actually use a technology tool. So it's very, very low. And there's this lack of awareness. I know I have some digital advice tool providers actually on this webinar at the moment. What is pleasing to see is, since the onset of the pandemic, there's more people exposed to actually wanting to use technology to help them with their finances, money management. And so that could be done in a number of two ways. That could be directly using the technology, or that could be through an advisor. So, we saw the massive uplift in trading of shares over the last 12 months, and I think that's going to obviously stay in train for the next at least 12 to 24 months, especially with the amount of stimulus. Now, I'm a believer, despite the fact that I jostled around my own super fund as to potentially what was going to happen at the early onset of the pandemic, moving it out of equities and into cash and all those sorts of things. I know some advisors are probably shaking their head at me there, but I think what we're seeing now, the massive stimulus, it will help bolster the market over the next 12 to 24 months. So these sorts of tools are going to become more and more important, especially the auto investing, trading shares. And there's still people affected by the pandemic, those that have permanently lost their jobs or those that have taken a permanent pay cut on the back of the pandemic. So it's no surprise to see tracking your spending and budgeting as one of the key tools that consumers want to use over the next near term. Despite that, as whilst we've got 20,000 advisors in the market, there is a further exodus of advisors planned. These figures are as at March 2021. So we've had one more exam result come through since then. And what we're only at 43% or 57% of advisors who have passed the exam, with six to 9 months to go of sittings, which I think is about 4 sittings. Someone may want to correct me at the end there, but there's about 4 sittings to go. And we know that obviously a lot of those advisors in the market currently do not intend on sitting that exam. So these numbers are going to come down significantly, especially in the stockbroking or the accounting space. And you'll see that there on these bar graphs, the accounting space being the limited licensee. So there are some impacts there to these numbers that will sort of come out in due course. And it's something that Advisor Ratings has spent a bit of time doing in terms of actually looking at each individual advisor in the market and determining whether they will or won't sit an exam and where they are in terms of their FASIA pathway. So that's going to be particularly important for any products out there or any sort of advice solutions out there to understand who your market is. Unfortunately, the biggest burden at the moment advisors are facing is in the life insurance space. We've seen commissions obviously come down to 60% and 20% in terms of upfront trail. It was at 60-30. And we've seen a massive outflow of life insurance or risk only advisors in the market. They're actually leaving at a rate of 240%. To 100% in terms of holistic advisors. Obviously, that has implications not only for the industry itself in terms of the profitability, which we'll get to for life insurers, but it's usually the very first point of call that advisors use as an acquisition point is to get people's insurances in order. And without those risk advisors, especially the holistic advisors who rely on the risk advisors, this is becoming a problematic across the entire sort of consumer landscape, is more and more Australians are going to be underinsured. And we already know that over the last 20 years, underinsurance has been a massive issue in Australia. The whole she'll be right attitude is very much alive and well in Australia. And it's something that the government, I guess, is not fully appreciative of in terms of the impact, not only to advisors' remuneration, but in terms of consumers having the ability to be insured, but also in terms of the life insurance profitability. And I know APRA is concerned, obviously, in terms of the longevity of some of these insurers. Now, switching and exits remain at record highs, and I'm going to get to, obviously, the piece that everybody's probably seen in my social media and on the AFR is whilst exits and switches continue to remain high, you'll see in 2019, 2020, the effect of the professional year as basically, advisors coming into the industry required to do that 1 year of training. Excuse me. It meant that the supply coming through is exceptionally low. And what I don't have a slide on in here is the impact on the universities as well. So we only have about 900 university applicants across all 3 years at the moment going through university. When you dwindle that down, we expect only about 25 to 50% to actually come through and become a financial planner based on historical sort of measures. And that's expected to even be lower considering the implications at the moment around compliance on particular advisors. So we're seeing a lot of exits. We're seeing the impost of the exam. We're seeing the impost of the FASEA pathway, and we're not seeing the sort of supply coming through, which ultimately leads to a further dwindling in numbers. And 13,000 is something that our data science guys have come up with based on all these metrics. Now, I know there's been debate as to whether that will be higher or lower, whether the government will come up with some appropriate legislation in the next sort of 12 to 24 months to ensure that that number doesn't dwindle down to those figures. And so I guess it's a wait, watch and see as to whether that pans out, but that is our best estimate in terms of where we're going to end up. And that has huge implications across the entire industry. In terms of product, in terms of consumers, and in terms of existing advisors, and in terms of the cost of advice. We already saw in the UK where these numbers were half that in terms of the 25% to 30% decrease. We saw an increase in fees. We're already at 30%. We saw an increase in fees to 50 to 100% in the UK. So, I expect fees to increase accordingly here in Australia. It does create, let's not be all doom and gloom. It does create some opportunity for advisors who do stay, and in terms of understanding which markets to exploit, I guess you could say, not only for your own benefit, but in terms of the affluent sort of areas within Australia. I guess that's from a selfish point of view. So what our data team do, we look at the population across 56 regions in Australia. We look at the funds under advice. We look at population growth rates, household income. So a lot of this is derived from the Australian Bureau of Statistics, also in terms of our proprietary database, to come up with, a ranking of the 56 regions in terms of opportunity. Not to say that all those 56 regions don't represent opportunity, but these are in terms of those metrics. So Sydney Ride Parramatta comes in at 5th. Canberra comes in at 4th. Sunshine Coast at 3rd. So Sunshine Coast, which is where Stacey is from. Sydney CBD and Melbourne CBD. So for those in Sydney, you've been trumped by Melbourne, which is always a bit of a conflict between the two cities. But anyway, there you go. We had Melbourne trumping Sydney. But all in all, what we do, and the reason for this slide is to really showcase the level of detail that we go into in terms of determining where sort of metrics, the different metrics are within across Australia, and where the opportunities reside, not only for advisors, but also obviously for products and different solutions. And it does showcase where the government and where the regulator, this landscape report does end up in their hands as to where they should be focusing their efforts. And what I'm saying is not necessarily focusing your efforts on the top 5, and it may be the bottom 20 where they focus their efforts. So now we'll get into, I guess, more practical sort of issues in terms of, and I'm not going to go into too much detail in terms of the licensee and practice landscape. I know I do have a lot of advisors on this. There is going to be a separate webinar hosted by one of our clients on that, where we're going to go into detail around some practice issues and some licensee issues that need to be managed and where the opportunities are. But we will touch on some economics. So the licensee economics, as those advisors are aware of, or if you're a licensee, you've had to increase your costs over the last, or the cost to the advisor over the last 12 months. We're now seeing, excuse me, I'll just take some water. We're now seeing fees are up to $40,000 to $50,000 just to sort of, I guess, not only break even, but just to keep the head above water at the moment. You know, and that's obviously coming down and impacting the cost to the client. We are seeing with some of the larger licensee groups, obviously IWF and MLC have been protecting their turf, you know, as part of the MLC transaction. So that is putting price pressure on the industry at the moment. What it does show, and I know there'll be some debate on the self-license space here, but it does show that scale is required for licensee economics to work and for licensees to meet their compliance burdens. The other data that came out in the last 12 months is what's considered attractive, both from an acquisition perspective, but also in terms of what licensees are looking for. So in terms of onboarding advisors, you know, I guess with the increase in compliance and spreading that compliance across multiple advisors, licensees are now looking at 3 advisor practice minimums in terms of wanting to onboard those advisors. Now, not to say that 1 to 2 man practices can't become an authorised rep under a license, but they're being far more choosy these days, licensees, considering the cost burdens. In terms of acquisitions in the M&A, on the M&A front, small practices, the revenues are holding up quite well. There are far more buyers in the market than sellers. That represents obviously some opportunity for those that obviously want to exit the industry. And I'd suggest if you are looking to exit the industry, you want to do so, probably start thinking about that ASAP rather than sticking around until the end of the year and where there's going to be a glut of practices in the market. So currently you do have buyers in this space. You know, the buyers are aware of the demand for advice not only now, but in future years. So that does bode well to recoup some of your investment. Now that has come up from the dire days of the Royal Commission, where it was more like 1.5 to 2 times. The large practices are much more in the EBITDA range. So looking for practices at 30 to 40%, 5 to 6 times EBITDA. You know, in terms of revenue, I'm talking about revenue of sort of 1 million plus there in terms of what you can achieve in the market. Now, that's a clean license. That's a clean practice without any sort of issues in terms of compliance. That's keeping your data up to speed and what have you, and making sure your clients are being serviced on a regular basis. Professional indemnity cover. That's one of the massive issues that's playing out in the media at the moment. Now, this is an issue that's been playing out for 10 years. So it's really just hit the radar now, given the huge increase in costs. Insurers at the moment, of which there are only a few, have been basically underwater in terms of profitability. So that's that increasing cost. I think we've seen an increase of about 50% coming through. Obviously, that places further pressure on practices keeping their head above water, but in combination with the ASIC levy and all those things. Professional indemnity and cover is only increasing at the moment. I think from our analysis conducted by Aon, the premiums represent 98% in terms of claims ratios at the moment. So there is still some way to go for insurers to cover some profit here and to cover their own expense base. So it's a matter of watching this space. We need to do better. I know there has been arguments around, is it wholesale advisors only that need professional indemnity cover? And the retail advisors can rely on this compensation scheme of last resort. It is something that's being debated in government at the moment. So we'll see. Hopefully that is something that potentially plays out to the positive for advisors in the near term. when we asked licensees if they're happy with profitability, I guess it's no surprises that there's a rump that are saying no. And there are others very much in that yes, but working to increase it. There's only a small number that are very comfortable with their profitability at the moment. And it just shows you how hard it is to run a licensee in this space with all the compliance at the moment. And this is where I cautioned, the self-license market before. What we've seen over the last 24 months to 3 years, a lot of these small practices that did attain their own license are handing them back after 3 to 5 years because of that increase in compliance and starting to merge. So what you'll find is that, especially as a product manufacturer that's trying to navigate this space with the disparity in terms of what's happening, obviously banks exiting, a huge increase or influx of self-licensed practices. I think you'll start to see a consolidation go on over the next 2 to 3 years as practices or licensees start to buddy up with each other, understanding where the benefits are, who brings what to the table. And we've already seen that in the last 2 years. We do expect that to accelerate given the profitability constraints within the smaller market. So as an advisor, what services do licensees offer? And this is something that, in terms of ticking the box, think of it like a laundry list, or think of it like going to the supermarket. I guess you pay for what you get. As you go down the curve or down this graph, obviously the costs start to increase in terms of what your expertise is at versus what the licensee is. And fundamentally, obviously, the one thing that all licensees offer is the AFSL, but the top 5 things are very much around an APL, a research-driven APL, the professional indemnity insurance that I was talking through. Professional indemnity insurers, as I mentioned previously, or I should have mentioned, it's very hard as a small license to get professional indemnity insurance cover. Obviously, that is one of the selling points from the larger licensees. And then professional standards, helping navigate the compliance and regulatory burden that is sort of in front of them at the moment, and making sure you tick all those boxes. And obviously, you go down the curve, and it all comes down to whether there's sort of acquisitions in place, or sort of what community programs are there, whether they offer, commercial loans or home loans, down to business financing and what have you. So it really comes down to a supermarket type of choice in terms of what you're after from a licensee if you're an advisor. What are licensees looking at in terms of criteria for new advisors? So the top 3 being the alignment of culture and values. There's a lot more due diligence obviously going on the advisor track record. We've obviously seen in the last 2 years some of the larger licenses fold because of the lack of due diligence, or more importantly, I guess the lack of compliance within those licenses. And so there's been a bolstering of compliance on the licensee side, and now they're looking at it from the advisor side. So anything from where they'd probably turn a blind eye previously, you've got complaints and audits. They're now being scoped, and due diligence being conducted on them, and right down to business model fit is the top 3. And then you go down to minimum revenues and minimum profitability, which was a surprise to us in terms of it. That's not a key focus of licensees at the moment. What has trumped up and gone through to the top of the curve, and this is through qualitative research rather than this quant research, is where are advisors sitting in the FASEA pathway. So if I'm an advisor that's only got a diploma, and I know I need to go and get a degree over the next 3 to 4 years, licensees are far more inclined to probably steer clear of you, unfortunately, rather than invest the time and effort to get you trained up. And that's more by virtue of the fact that they, that the cost burden isn't borne by the licensee, and the issue of whether the advisor runs the risk of leaving that licensee after being onboarded. We're going to jump into the investment landscape. As I said, this is quite overarching or broad-reaching, this webinar. So we've got a few key themes here. So jumping straight into the investment landscape, which I know a lot of fund managers are on this call at the moment. So there's 5 key themes that I'd probably explore here is the strong growth in all asset classes over the last 12 months. That has obviously helped advisors in terms of retaining clients, and also in terms of retaining confidence, especially when we all thought the world was going to end back in March 2020. We realized it didn't. In fact, from a stimulus perspective and from an asset perspective, we all became a lot richer. So that's playing out. It gets to the positive for advisors. ESG, number two, it's been the talk of the town, especially at insto level. ESG from super funds and the sort of, I guess, the investment from pension funds and the like, there's been a massive influx of money that way. But retail wealth is not really, the advisor space and investors, mum and dad investors, haven't been brought into the ESG sort of, I guess, fanfare just yet. So there is jury out for growth in that space if you are a sort of product manufacturer or a fund manager looking at the advice landscape as to whether ESG ticks that box. Obviously, it comes down to real best interest duty and sole purpose test as to whether I'm investing for the right reasons. I know that's something that I know Senator Jane Hume was obviously on the warpath about in terms of some of these super funds focusing very much in this area. The third one is around listed structures, and particularly around ETFs, the further growth of ETFs and ETMFs. What we're seeing now is listed structures really help advisors tick that regulatory and transparency box. With ETMFs, so that's actively managed ETFs, so exchange traded managed funds, which we focus quite a bit in our landscape report. Obviously, with the likes of Magellan and PIMCO coming into this space, we're feeling like it's going to be quite a disruptor to the traditional active non-listed space. So it should be an interesting time, obviously more choice and more opportunity for advisors, but it's about grappling, as if I'm a fund manager, it's about grappling with where do I focus my efforts over the next sort of 12 to 24 months in the retail wealth space. The other thing that we're seeing through our research is the free research. Obviously, this is free yourself. So the free research disrupting the research houses. So, the likes of Morningstar, Lonsec, and Zenith, the traditional research houses that we all subscribe to, being uprooted or upended. There is some disruption in that space. Fund managers now offering free research. A lot of the obviously licensees and advisors have to tick that box from a compliance perspective, but the amount of free research that's coming out from the platforms and the fund managers' point of view, and also from the investment consultants. So to a certain extent, offering some research capability, especially the bigger ones, which is 0.5. So watch this space, what that actually means in terms of, cost. Hopefully that's a reduction in costs for licensees and advisors in the short to near term. But what does that actually mean for some of the bigger research houses and in terms of where they go? And we've already seen some of those vertical integration or some integration into other areas in terms of what researchers are doing to supplement the loss of revenue there. The explosion of investment consultants, you'll see here as we move, as advisors and licensees move to MDAs and SMAs, they start to claw back some of the lost revenue that through actively managed funds and what have you. There's been a surge in the use of, I guess, investment consultants in this space. The traditional Lonsec, Morningstar that do offer these services are now being trumped by some smaller players that have either come out of these firms or set up shop. And we do expect this to grow over the coming year or two. You'll see the NPS of some of these investment consultants. So it really does come down to service. It's niche. It's about really servicing a handful of clients or a handful of licensees. And you're seeing that through the Net Promoter Score. It's all about advisor support. And what I would say is going back to the original term that I used at the very front of the conversation or the front of this webinar is empathy. A lot of these investment consultants are not only working on expertise, but working on an empathetic approach in terms of this space at the moment, which is showing through some of these Net Promoter Scores. So if I'm a fund manager, what makes me a winning fund? Some of the research out of this is around focus. Those funds that have focus, that are not trying to be all to everyone, are starting to win the game with advisors, and the focus on actually pitching to the right advisor. So knowing who your advisor is and knowing where to focus your efforts in terms of, if I'm a long equities fund, I should be focusing on long equities funds. If that's what my investment mandate is, and that's what my investment manager is good at, let's stick to what I'm good at, as opposed to chasing the next shiny ball. Performance, when it matters, that always counts. Obviously, those who are outperforming the market tend to are doing a lot better at the moment. Advisors, given the influx of research that they've now got exposure to, are being far more choosy around performance. It's an expectation of their clients, especially as they've divorced their lower value clients. Obviously, the clients that there's a higher service value, and performance for those higher value clients is far more important. The use of data and segmentation. So what we've seen is, and we'll see this in the next slide, just to give you a precursor, is there's this downsizing of the advisor space, but everyone is upsizing their BDM market. And is that the right approach? Those that are basically segmenting and using data well are actually doing a lot better, because they're reducing the cost within their own business, but also those costs can then parlay into the advisors and the licensees and ultimately the end consumers. So the use of data segmentation is going to be a real key from a distribution perspective, but also from a DDO, so from a compliance perspective as well. Multiple selling pitches. So if I'm a fund manager, I should be able to sell at both the coal face over the phone, right up to the CEO level, and giving that focus to the advisor and licensee community, and being targeted in those conversations. The last thing advisors want, and I know a lot of advisors get sort of 200-300 BDMs, calling them up, probably every 6 months or so. So being able to be very targeted in your selling pitches to advisors, and at all levels, from the receptionist who picks up the phone to the CEO. So making sure that you have that in place. And the integrated investment team support. It goes without saying now, it's not just the BDMs being able to come across and pitch a product. It's about having the investment team there and talking through the philosophy of why that product is important in the hands of a particular advisor or in the hands of a particular consumer. Now, jumping from investments into life insurance. Now, I haven't got given the risk space is made up now. I think we've only got about 5% of the market that are pure risk advisors. I'm not going to spare too much time on life insurance in this presentation, other than to say the newcomers are being tried at the moment, and they're shining through. Obviously, the whole sector itself is going through a profitability crisis, and we made mention of that up front. With disability income being mispriced over the last decade or so, the massive increase in repricing across the board has meant that policies are lapsing at a high rate, and also advisors, the expertise of advisors is no longer there because they've exited. So, unfortunately for insurers, that potentially does create a vicious cycle. And I know the likes of AIA and TAL have done the rounds at the moment, in terms of trying to, pitch to government and the regulator, APRA in this instance, around how do we get Australians access to advice. What insurers obviously can do without having to reset or increase commissions again, which doesn't look likely. I'd like to think that the current commission levels are probably going to stay the same rather than being void entirely. But what insurers can do is to have a look at their onboarding processes and to have a look at the efficiencies that are coming through how they look after advisors. And you'll see that that's what NEOS, Integrity, and to a certain extent MetLife have all started with blank canvases to work with in terms of the onboarding process. Despite MetLife using a lot of their legacy tech with Group Life, what we're seeing now is, the old onboarding processes, the technology constraints of the incumbents are now starting to play out to the frustrations of advisors, where insurance was a particularly commoditized product in the last 12 months. I think the investment in technology has been key. Now, you'll see there MLC Life had a disastrous year in the last 12 months. There were issues across the board when it came to their technology, both from an onboarding perspective and an advisor support point of view, which lends itself to the next slide, which is around different components advisors look at in terms of, and we break it down into 6 key components that advisors look for when choosing a particular life insurer. That's ease of underwriting, platform functionality, the competitiveness of the insurer, the comprehensiveness of the modules offered, advisor support, and claims handling. And you'll see across the board there, NEOS has trumped others for the 2nd year running, but MLC, obviously, with its disastrous year, we're starting to see a lot of flows or a lot of sort of policies written out of MLC into the newbies. And we do expect that to, based on the qualitative research that we've conducted recently, we do expect those flows to continue into the new players. Now, I'm cognizant of time, so I will speed up this presentation. The great wealth transfer. So this is what's happening at the moment. Obviously, the boomers, it's something, around the demand for advice. This is research that was conducted by Griffith and Perpetual in terms of the overall market of 3.9 trillion over the next decade is to be transferred between boomers and to Gen Y. So it's really about understanding, it goes up to the slide up front, is around, the millennials and the Gen Yers now at the moment hold the cards for the future of financial advice. And pleasingly, they do want advice. And there's going to be this transference of wealth now at the moment as the transition to retirement happens and the boomers are looking to get hands and help out the Gen Y generation. So it is something that advisors need to be cognizant of, and it's also something that product manufacturers need to be cognizant of when producing tools. What this slide represents is what licensees and practices are doing in terms of, the way that that's going to facilitate this big wealth transfer is through how you're offering digital services or applications. So smart tools is what we call them here at Advisor Ratings. So what we're seeing now is licensees and practices are starting to offer these tools, not only for their advisors, but in terms of clients coming through the pipe. So the low value clients that we talked about, where cost is prohibitive from a holistic point of view, there now needs to be considerable investment into this space. And what does that look like? Very much could be a fact find tool right up to a more digital application, or partnering with firms like, the likes of My Prosperity, MoneySoft, those sorts of tools where, once you can sort of capture whole of life cost of living, it then goes to the next level, which is holistic advice once they can afford it. And we'd like to think that that's going to happen sooner rather than later. Fingers crossed, just, with legislation, hopefully at the forefront of government's mind in terms of changing to reduce those costs. Which brings me to the next area around digital. I guess some of the digital players out there at the moment that are looking at this space. Where we've got Fin365's Raw Software, we've got Infocus's Platform Plus, Astute Wheel, and Class, which are all investing into their software at the moment to actually make the experience better for not only the advisor, but for their client. And we'll start to see a lot more of these services come through, or these softwares come through. And I think it's important for advisors to be cognizant of what's in play and to start to address them within their practices now. Xplan, by virtue of its incumbency and its complexity, has always struggled it down there in that space. It is it is obviously the main player with 60% of advisors owning that. And I am aware that further investment is being made to open up that platform. In terms of platforms themselves, investment platforms, so the big six, we've got Net Wealth, Hub24, Wealth02, BT Panorama, CFS First Choice, and Macquarie Wrap. They're the only 6 platforms in 2020 that had a positive net promoter score. So again, this backlash, I guess you could say, by the advice community in terms of the support that they were given through the crisis, it was a backlash against software providers, platform providers, life insurers, and the like. I think there's going to be far more focus by advisors in terms of where they place their funds and who's actually supporting them. And it goes back to my initial comments at the front end. Is I think support at the moment is a key point. Whilst the tech may not be up to scratch from a certain standpoint, I think it's the support over the next 12 to 24 months that advisors are looking for as they transition to either re-engineering their business models and or in terms of exiting and helping out those clients that are potentially going to be orphaned. You'll see the platform category scores, obviously, the Hub24s, Net Wealths, and the premiums here across the board are doing far better than some of the sort of incumbents. A poor year for Perpetual, Wealth Focus this year. ANZ obviously winding up its platform or transitioning their clients, rebranding that platform. We're going to start to see, there is the challenge or the base or the race for the advisor and the race for the end client amongst the platform community. And that bodes well for advisors. More and more investment into the platform space. I think we're going to see a reduction in fees as new players come out from the US. So from that perspective, lower fees, a better experience is all shining through the platform space at the moment. Now, jumping into super, the key themes in the super space at the moment, obviously super funds, and we've got Australian Super's logo there, is should they license or should they not license? We've seen 2 big moves over the last 12 months, or even more recently than that, with Q Super and Aware Super getting out of owning advisors, so going down the third party route. We'll start to see that in terms of, are super funds going to be the next, big vertically integrated play in this space? What are they going to offer? Can intra-fund advisors fill the mix from the perspective of cost of advice? It is something that's obviously on the radar of both the Federal Treasury and to a lesser extent, Senator Hume's office, but I know it's something it's at the forefront of what super funds do in this space, especially as a lot of their clients start to transition to retirement. We've seen mega funds start to come into play with the scale regime. A lot of mergers going on. We're going to start to see more and more mergers come into place. Obviously, APRA is focused on scale and sustainability, and for those fees to start to come down significantly and be passed on to consumers. So what does that mean for advisors? Well, one, it means hopefully, obviously lower fees being passed on to your clients if they are in a retail or industry fund, but it also potentially means the funds themselves do become competitors. Finally, the transition to retirement. So you're starting, obviously, to see the super funds themselves start to partner with firms like ourselves. Third party, we offer now a fund and advisor solution. So third party advisors, such as many on this call, starting to see volume coming through from super funds, but also in terms of services. I mentioned their Generation Life, who are now offering annuities to third party members. You'll start to see a broadening of product ranges and a broadening of services as super funds try to retain those clients, given they've had no retirement products up until this point. The distribution challenge. So we're in the final stretch, guys. So you can go grab yourself a coffee or a tea. The distribution challenge for anyone, all the product manufacturers, what this represents is the bowl and the food represents the advisor. And then you've got the smaller players at the moment who have been servicing the advisor quite well over the last 12 months. And I keep using that term, empathy and support, being very protective of that relationship. And then you've got the big BDM teams or the big fund managers, the big life insurers who actually are focusing in terms of hiring more BDMs to get access to that advisor space. Is that the right strategy? Is something that we especially as the advisor space has decreased, it's decreased 50%, as we mentioned. We've got 178 firms in the market servicing advisors with a workforce of 1,003 BDMs. At a cost of $325 million to the industry. And I guess the question is this distribution value chain built for a population that's more like America or the US as opposed to the 25 million consumers in Australia? So I think, product manufacturers, both as compliance plays out with the design and distribution obligations, need to be smarter about how do they approach servicing the advisor. Give them what they want. Advisors, obviously there's going to be less of them. There's going to be more BDMs. You're not going to get the same time in front of the advisor that you once would. How do you invest your dollars more wisely? The most important success factor, this is based on a survey of 100 heads of distribution across fund managers, life insurers, and the like. And it shows the complexity of the actual advice channel itself. Depending on if you're a fund manager, you're going to focus more on your product or service or the company brand to represent you in the market to the advisor. Now, right down to if you're a research house, you're going to look at, or if you're looking at, a fund manager as well, whether your product's going to be rated, whether you're going to get on the APL of particular licensees, down to if I'm a life insurer, where most life insurers are already on an APL, it's very much the relationship with the advisor and the practice. And what I think you'll find over the next 12 months is how is more investment going to go into that relationship with the advisor and the practice without upsetting the advice channel to a certain extent, given they've got their own time limits. And, the one thing that they want most of all is to spend more time in front of their clients, not spend more time in front of a compliance worksheet or a BDM. So it's about picking your time well in terms of what that relationship and making sure that you're harnessing the right relationships. Now, from a distribution team perspective, again, this one is more targeted to the fund managers and the life insurers on this call and the software providers. There is concern at the moment that the teams that you have in place aren't quite the right size or the investment. So we are seeing a shuffling of the deck chairs. Even ourselves, who do have relationships with everyone at the moment in this space, we are basically having different conversations. We'll find someone is at this fund manager X and they'll move to fund manager Y and they'll move to fund manager Z. And that's happening at the moment. It's about really working out what your value proposition is and what type of talent you want in your organization. And it's about ensuring that talent is very much up the curve in terms of what you're selling to an advisor, and do they have relationships with that advisor. And finally, that can only be achieved through a complete data set. It's really understanding the advisor. It's really understanding the advisor's wants, the needs. Do you have the data's? Do you have the advisor's current needs and unique insights at your hand? And that is something, obviously, I guess this is our CTA in terms of that is obviously something that we play well at. I think, to a certain extent, we have a great relationship with advisors. It's all about giving back, and in return, our proposition is really helping product manufacturers get in front of the right advisor and also not wasting advisors' time. So really, that's a quick overview. I was supposed to finish at 1:45, so apologies, I did go over in that time. So I know we don't have a lot of time for questions, but hopefully that gives you an overview of the financial advice landscape market. It was hard summarising an 800-page document into 30 slides. So I want to thank the team for giving me the key points to talk through. But if you do have any questions, I'll try and answer a couple now. Stacey.
Hi, lots of great comments here on the presentation. Thanks, everyone. So Angus, we've got a few questions. What time frame does the landscape report represent?
It represents, so it was conducted from November 2020 to February 2021, where most of the surveys were conducted. So it's fairly relevant. Obviously, it was printed in April, so we tried to keep the currency of the data right up until March, especially where it came out of ASIC and APRA.
Okay, next question. We've got a question saying, where do you see Xplan going?
Interesting. Well, they're investing a lot at the moment in there's a big focus for Xplan in the product side and the product manufacturing side to help advisors with design and distribution obligations. Obviously, there's a few players in the market that are trying to take them on. There's two key ones that have come into this space: Advice Intelligence, that have that are just about to launch, and IntelliFlow that's come out from the UK. And they've already been onboarded by Centrepoint Alliance. So I think you will start to see a renewed vigor by Xplan in terms of, one, the proposition, and also two, in terms of looking after advisors. Now, incumbency is always one of those ones that's hard to displace, especially if your solution, Xplan particularly, is really embedded across the ecosystem, which it is for advisors. And I'd say that that's a cautionary tale for the newcomers like Advice Intelligence and IntelliFlow. But with a fragmented market, now's the time for new players to at least make a dive into this space. That said, it's a smaller market. It's a niche market. It's been hard for new software to come into this space. So it's a great time to be an advisor when it comes to software.
Okay, thanks, Angus. Next question we've got is, in regards to consumers seeking advice, you mentioned boomers and Gen X. What about Gen Y?
Gen Y. Gen Y, well, I'd put them all into the same bucket. Gen Y, millennials, and Gen Y very much at the upfront start of the conversation, far more tech savvy, far more inclined to want their advisors to be aware of what's happening, both from a social standpoint, but also from a technical standpoint, a technology standpoint. But what we have found as part of this is that the financial literacy has actually declined over the last 10, 20 years. And so what you're seeing now is, and that's shining through in terms of millennials and Gen Y wanting advice. We talk about, we did ask those segments of the market, or all segments of the market, to self-rate their financial literacy, and the Gen Y and millennial market are far lower in financial literacy than the boomer generation. So that's a concern in itself, but obviously to fill that void, that's why they're seeking advice, which holds the industry in as we get through this period of, this cathartic period over the next sort of 2 to 3 years. I think longer term, the demand is going to make sure that advice stays very strong, which is pleasing to see. It's just that, unfortunately, I'll be upfront, we've had an overzealous regulator and government in terms of the impost with costs in this industry.
Thanks, Angus. Okay, next question we've got. Why do you think AFSLs don't overly care about practice profitability?
I don't know if that's the case. Despite that's what the survey represented there, I think it's more by virtue of the fact that there has been a move away from FUM-based revenue. So that's that. I think we need to think about the way probably the question and the answer was framed, and I think it's much more towards now fixed fees. Compliant, there's now a fixed fee to basically service an existing advisor or an existing practice, and now that's being shown through the fees coming through from licensees at the moment. There has been a shift away, not to say that it's not in place already, there has been a shift away from that funds under advice type fee. That said, there is a new model that's taking place, and you've got the likes of Count Plus that are in this market, where they're starting to take JVs or equity stakes in practices that it makes sense. So there has been a shift away from the FUA more into the equity stake.
All right, thanks. And one more, we might make this the last one. There's a few other questions that I can get back to the questioners individually on. But the last question is there any data directly from universities as to why the high dropout rate and low rate of students taking up the advice profession? What else do you think can be done there?
Yeah, that's an interesting one. We have spoken to several universities on this front. Unfortunately, it's a lot of the backlash has really occurred because the industry hasn't been cohesive in its messaging, I think, to the financial planners. It's something that we discussed with Senator Hume in terms of the infighting is playing out, not just within our own industry at the moment. It is now sort of cascading out into the wider sort of market, and that's sort of impacting university graduates' decisions around coming into an industry that's looking very disrupted, that's looking like it can't get its act together. So I think it's incumbent upon everyone in the industry to start having a single narrative around why financial planning is important, what are the upsides of that. And I think you'll start to see a change in universities' thinking at the moment, or especially the students. I know one of the, it's really about fostering talent practices. And most of this, unfortunately, is compliance burdens as well. We've got one of the firms, Striver, who are trying to obviously place university students in certain practices. Now, it's very hard. There's a bit of pro bono work that practices need to start offering in terms of bringing students and supply through the value chain here and into the industry. So I think, unfortunately, it's a lot of the noise in the media that's deterring a lot of the university graduates. Far easier to go, should I go into financial planning that can't get their act together, or should I go into accounting? And I hate to end it on that note. But
I'm just going to sneak one more through, Angus. So the last question is, where can I obtain a copy of the full report?
So for advisors, we are sending out an abridged version. It is an expensive report I'll be honest, up front, is an expensive report, the full report for product manufacturers, but we are compiling what's known as an abridged version for advisors. To thank you all your time. You also, if you haven't already, you would have received, if you filled out the survey, your own regional snapshot. And if you haven't been sent that, please chase Stacey, if you don't mind. And we are actually putting that together at the moment. So you will see, which is going to be very much focused on you as a practice or you as a licensee. So a lot of the other peripheral stuff will fall into the major report.
Perfect. I think our time's up.
Great. If anyone's got any questions, please throw them over to myself or Stacey, and we'll do our best, to get through them over the course of the next week or two.
Yeah, and we'll send you all a follow-up from this presentation as well, so you can reply to questions on that as well.
Thanks, everybody.
Thank
Ciao.
you. Bye.